Hey, welcome to Stocks, Tech, and Beer, where we talk about stocks and technology while enjoying a cold beverage. And today we're going to talk about the IPO market because it's hot, it's sizzling. Just this past week alone, there were three huge tech IPOs that came out. We had Snowflake more than doubled on the day. We had JFrog shoot up 47%. Unity Software, which got the coveted single letter ticker symbol U, that shot up 44%. These are all massive one-day gains for our portfolio, ones we'd all love to see in our portfolio. But the IPO market is rigged against the average investor. I'm going to tell you how to get around that in a bit, but first let's take care of business. If you don't like the business part of this video, just skip ahead to the next chapter, you can move on. But if you find any kind of value in this video, please hit the like button here and subscribe to the channel to help everyone out. Second, this isn't financial advice. Just guy sitting here drinking a beer, talking about the stock market. I mean, you got to do your own homework. I'm not responsible for any actions you take after watching this video. And today I'm drinking an IPA. It's my last beer from the Eagle Park Brewery in Wisconsin. One of my favorites there, probably definitely top two. And I got the Citra on the dock of the bay right here. It's a New England hazy pale ale. As you can see, nice and hazy, delicious looking, and it is definitely get the grapefruit in the nose and a little bit of hops on the finish, and the finish is crisp and clean. Love it. We'll give this one 8 out of 10 again. I mean, we're drinking good beers here. I'm not going to the bottom of the barrel quite yet. Got lots of other videos where we can get some crappy beers, but we had some good ones lately. This one didn't let me down. Super happy. Eagles Park, you got it going on. All right, now going from IPAs to IPOs. An IPO is an initial public offering. It's when the stock goes public for the first time. It's the first time the average investor, like you and me, is allowed to get in on shares of the company. Because before then, it was all private investors, either insiders in the company or private equity or venture capital funds. It's off limits to us. And the traditional process is rigged against you and me. And here's what I mean by this. If we tried to get in on the initial allocation for Snowflake, the $120 that the insiders paid, or the rich people like Berkshire Hathaway got a $250 million allocation of Snowflake for $120 a share. If we want to get that, we got to be connected. We got to be Berkshire, or we got to be just have a loaded brokerage account. Because if you called your brokerage account and were like, hey, can I get an initial allocation to the Snowflake IPO? They'd probably tell you that your account's ineligible for hot IPOs like this. Hot or popular. Wall Street calls these hot because everyone wants to try to get it. And what you need to have to get access to these IPOs, if your brokerage even gets an allocation to it at all, but you got to be a top tier client. So that means you got to have at least $500,000 in your account. You got to be doing a ton of trading. You got to be a valued customer, or you're not going to get it. Or if you do get it, you don't want to be in that IPO because it's not a hot IPO and it's going to just tank after it goes public. So, you know, Groucho Marx says he doesn't want to be a member of any club that'll have him. I don't want to invest in the IPO that'll let me invest in it. It's the same kind of deal here. Right now, it is rigged, and I recommend staying away from it because what happened with Snowflake is insiders, Warren Buffett's Berkshire Hathaway, they got their allocation for $120 a share. But what was the first price investors like you and me could buy on the open market? $245 a share. So that $125 difference between the two all went to insiders. It went to the people who had the allocation already. It didn't go to the investor. And now Snowflake's gone down, and it's probably going to go down a little further because it was just ridiculously valued. It was valued at the market cap, how much the total of the company was valued at 200 times their sales. And in no world is that a normal kind of valuation for a company that's not essentially pre-revenue. And Snowflake's definitely not pre-revenue. They've got a decent amount of revenue coming in, but the value of the shares are just ridiculous right now. But anyways, regardless of it being expensive, that whole gap between the 120 IPO price that it went public at and the 245 that it started trading at, that all went to the rich people, it all went to the connected people. And it's a shame. The traditional IPO process is screwed up, and it's just there to help the connected people. And when the politicians or whoever, the Wall Street guys, say like the rules are here to protect you and me, no, it's so they can keep their profits themselves. No one on Wall Street is altruistic like that. They're not trying to help us. They're trying to make a quick buck for themselves. Don't let any of that talk dissuade you from this. Like, it's all, everything from Wall Street, Washington, D.C. politics, it's all self-centered. It's all about how it can help those in power, those with the money, keep the money and the power. So it's been too early to tell for these three companies last week that went public if they're going to go down or not, even though I think they are. But you can look at a company that went public just a month or two ago, Lemonade. This is a online first insurance company, and it went public, or the IPO priced at $28 a share. It started trading around 50 and went all the way up to 85 shortly thereafter. But then after it peaked out at 85, it's dropped down to about $50 a share now, and that's money that is just being taken away from people who bought into Lemonade, thinking it was going to keep going up at $85 a share, but it was clearly maxed out at that point. And this is a common thing amongst IPOs. I mean, look at this chart of Uber. It came out at $45 a share when it first started trading, and it bottomed about 6 months later at $27. And Facebook did the exact same thing. In May of 2012, it came out, it started trading around $40 a share, and shortly after, it dropped over 50% and bottomed out about $17 a share. And it really didn't start taking off until about 6 months later in November. Picked up a trend between these two companies that I've showed you, Uber and Facebook, like 6 months they started taking off. What happens at that 6 month period? That's when the insider lockup period expires. And a lot of times Wall Street will sell stock into this lockup expiration knowing that there's going to be more supply hitting the market soon. They don't want any part of that as soon as it hits. Because a lot of times you see the stock kind of just tank as insiders try to sell. So I don't typically buy any shares in the first 5 or 6 months of trading. I wait till I see it bottom out, and then I'll go and try to buy if I like the company and the valuation after that. And that's just a better way to go about it. I mean, do I miss some large gains? Yeah, I miss a few that just take off and never look back. But those are rare. Those are the exception to the rule. And even though I miss out those large gains, I probably miss out on taking huge losses more so than I miss out on gains. So for me, that's what I do. So how do we get in on the large gains, those IPOs? So you can get that money between the 120 to the 245. How can you get that? But you thought I'd never get there. But the answer is it's this new-ish kind of investment called the Special Purpose Acquisition Company, or SPACs for short. SPACs are also called blank check companies because they have a large chunk of cash waiting to take a private company public through the markets. And if the SPAC succeeds, investors in the SPAC get to cash in. And one thing I really like about these SPACs is if you get into them right away, usually in the first 50 days of trading or so, you end up buying what are called units. And each unit of the SPAC comes with a share and a warrant. And a warrant is the right, but not the obligation, to buy a share of the company at a future date, up to usually 5 years in the future, for a set price, which for most SPACs is $11.50. And the only way that the SPAC is going to be more than $11.50 after 3 years is going to be if a deal gets affected. Because one of the cool parts about a SPAC as well is this cash sits into account, and in the deal sheet, in the S1, the filing, if the SPAC company doesn't affect in a merger within usually 24 months, all the money gets returned back to the investors. So that's it's almost like a money back guarantee. Like if a deal doesn't happen, you get your money back. And usually you get the full $10 a share, maybe a little less, because they got to take out some fees for the auditors and the SEC filings and stuff like that. But a lot of times that gets made up because the management company, the founders, will buy a bunch of warrants for cash, and then that cash covers the costs for all those kind of random fees. So investors usually get their full $10 a share back, assuming, in the rare case, I mean, it's super rare. It's like 5% of the SPACs that actually return money to investors because of this. Most have a company that want to go public to take public, and then the SPACs take off. So that's a cool part. You get a money back guarantee, plus you get this warrant kicker. It's kind of like a lottery ticket, and it essentially doubles your gains if a deal gets affected. So It's pretty cool to get both the share and the warrants right away at the beginning. So I like to try to find SPACs in the first 50 days of trading or so that you can do this and get that combination. Because, I mean, if you're really lucky, after the split, the shares will be worth as much as you paid for the unit. And if you're super risk averse, you can sell back the shares, take your full money out of the investment and pocket it, but you still have these warrants just in case something happens. And that's a pretty cool thing. All right, so let's see how some of these SPACs do after they merge with a company. So we have IPOA here. This one was headed up by Chamath Palihapitiya. He was a early investor and employee of Facebook. If you see this chart here of IPOA, this is the social heliosophilia, whatever you call that, acquisition company at the beginning. And this company eventually merged with Virgin Galactic Holdings, and now it has the ticker symbol SPCE. But as you can see in this chart here, it didn't do hardly anything from about September 2017, from when it launched, till October 2019, when Virgin Galactic actually agreed to merge with Palihapitiya's SPAC and become publicly traded. But you can see after that, it soared. It went from, about $10 a share, had a little volatility as some investors were confused by what was going on. But eventually it ended up jumping 260% before the market came tumbling down with this COVID-19 pandemic. And what's also cool is the warrants there as well. I mean, they went from, I don't know, just a couple dollars a share to almost $25, and that's a 1,300% increase. And that's the cool part about the warrant, is that it's had a little more leverage in there, and because the warrant's going to have a lower price than the shares, it'll have a bigger percentage gain. So you could play just the warrants too if you want to just buy that, but there'll be a little risk if the deal doesn't happen. You don't get your money back in the warrant like you would in the shares. So something to keep in mind, the downfall of that. But if you get the free warrants, free lottery ticket, hang on, let it ride. Palihapitiya also just had another one, his second SPAC, have a merger with Open Doors. Happened just a week or two ago. So this one went from about, IPOB went from about 10.5 to looks like 17.5 beginning of last week. And that's a pretty good run. It's since pulled back, a little volatility in these, but I don't think Open Doors is quite as exciting as Virgin Galactic. However, at least Open Doors got revenues, and I don't know if it's profitable or not, but it's close. It's closer than Virgin Galactic, at least. So that's an exciting one. We also have Diamond Eagle Acquisition Company, and this one merged with DraftKings. And you'll see here it went from a little over $10 a share to about $45 a share after it publicly traded. But you also see here it went from like 10 to 17 right away at the beginning. That had some volatility, kind of like Open Door did. And then once investors were able to see the financials and know that it was happening for sure, then it really took off. So a lot of times you get a second opportunity to get into these even after the pump. And that's you might have that opportunity at Open Door right now. I don't know much about the financials. I'll wait to see until those get released, and then maybe I'll have an update or maybe I'll forget about it. So if you hold on to these SPACs for a little bit and wait for them to go public, eventually you'll see some IPO-esque gains come to your account. Now, it's not going to happen in one day like it does when Snowflake did that, but you get that little in between, that liquidity premium when it gets unlocked between being a private investment and a public investment. It becomes more liquid, and liquidity is a nice thing to have, because if you need to sell it for any reason you can, whereas a private company, it's a lot harder to sell your shares. So having the opportunity to sell shares whenever comes with a price. The price investors want, and they're willing to pay more for it. So that's why the share price goes up like that. But as you can see in these companies that are merging with the SPACs, you get that gain right away. And that initial gain, that's kind of like the IPO gain, because now it's going to be a liquid company. And you get to keep that as an investor. So that's why these SPACs are so great. You get to keep that IPO premium that usually went to insiders, but now it goes to someone like you and me who can buy these SPACs. So that's why I like SPACs, and that's why I own a few of them myself. So what are the good ones right now? I mean, the biggest one out there right now is Bill Ackman's SPAC. That's the Pershing Square Tontine Holdings. And that just split its units So the shares and the warrants are now separate, and that split happened automatically, which doesn't happen in every SPAC. But this one they did, and it just makes it easier. It just happens automatically. Boom, you don't need to go call your broker and instruct him to split the units. So this had just happened, and it's doing all right now. And people think Ackman's going to bring a large private company public because he raised $4 billion. So he's got some big companies out there he's talking to, and hopefully one of them take him up on it, because the SPAC process is actually better for the companies going public as well, and the investors. I mean, it's really a win-win for both sides. I'll talk more about that in another video. But that's why I think Ackman will ultimately be successful. He's a big name in the hedge fund investment community, and he's going to find someone to take public. What else is there? There's the another one that I personally own, full disclosure, is called the One SPAC. It's ticker symbol AONE. And this is led by the guy who started the Zoom with an XOM payment service that got acquired by PayPal. And that was actually a super good service. It saved me in Panama, and I was trying to pay rent when I was staying there for 5 months. It's the only service that would transfer money from the U.S. to a foreign country. Anyways, random side note, great service, and now it's part of PayPal. I haven't used it since, so I don't know if it's any good or not. But he also brought Eventbrite to the public markets as well. And this guy's a deal maker. He's gone through it. He'll be a great partner for any private company looking to go public, and a great resource. So I like that one as well. He's going to find someone. Someone's going to work with this guy. So it's just a matter of time until you find someone to take public as well. And I mean, there's more. I'll talk about SPACs more in the future. It's getting a little long. I just want to say that the traditional IPO process is rigged. This last week has shown it for sure. Absolutely, no doubt in my mind, it has shown it. Because you see Snowflake, like they said initially they're going to price it at $70 a share, but there's so much interest that the investment banks running the IPO priced it at $120 a share. But actually they undercut it because people were willing to pay over $250 a share by the time it finally went public. And that's a large gap that we didn't get to partake in, and it only went to the insiders. So a SPAC gets us around that and helps us get to keep some of this profit that normally went to the insiders. And I hope the SPAC vehicle becomes more prevalent and more acceptable for these private companies to do, so we have more opportunities to get these kind of gains that were previously safe for Wall Street. So if you want these type of gains, you can do some research into SPACs. You really got to look at their SEC filings. The S1 is the one to look at, and the S1A, which is the amendments, which they'll file going forward as they know more information about it. But that's really where you got to dig, and I'll tell you the one or two factors that really matter for a SPAC in another video as well. Just be patient as I film these and drip them out. Got a busy couple weeks ahead of me. Appreciate it. And until next time, cheers, friends.